One of them is 34 years old. He has $980,000 in his investment accounts. He checks his portfolio every morning before coffee. He reads every article. He stress tests every allocation. He tracks his net worth in a spreadsheet he built himself with conditional formatting that turns red when things go wrong. He has a color-coded system for his color-coded system. He is, by almost any objective measure, doing extraordinarily well. He does not feel like it. The second person is also 34. She has $1,050,000. She checks her portfolio maybe once a month. She does not read financial news. She has not changed her strategy in 3 years. She could not tell you what the yield curve is doing right now, and she genuinely does not care. She sleeps 8 hours a night. Same age, same approximate wealth, completely different psychological universes. Here is the question nobody ever asks. What actually happened to her? Not financially, psychologically, mechanically. What crossed over when she crossed that line? Because the uncomfortable answer is, it was not discipline. It was not patience. It was not some superior philosophy about money or a guru she found online or a book that changed everything. It was a number. And that number changed the math entirely. And once you understand why, you will never think about investing the same way again. Part 1. The illusion of effort. Here is something they do not put in personal finance books, because it is slightly demoralizing to say out loud. For most of your investing life, you are essentially irrelevant. Not you personally, your behavior, your effort, your contributions, the heroic monthly deposits you are making while skipping vacations and driving a car that embarrasses you at the valet. For a long time, those matter enormously, and then gradually, they do not. Here is why. From roughly $0 to $400,000 or $500,000, the primary driver of your portfolio growth is you, your savings rate, your income, how much you manage to shovel in each month. The market helps, obviously, a strong year is welcome, but the heavy lifting is still human. You are the engine. This is why the early years feel like a grind, because they are a grind. You are quite literally outrunning the market on a monthly basis. Your $2,000 contribution to a $50,000 portfolio is a 4% addition. The market has to have a spectacular month to match that. In an average month, you are contributing more than the market is generating. You matter more than it does. So you run the numbers. You optimize, you agonize over expense ratios and the Roth versus traditional debate, and whether you should tilt towards small cap value because a paper published in 1993 suggested the premium might persist. You feel like every decision is critical, because in this phase it sort of is. Your behavior matters enormously. And then something starts to shift, not suddenly, gradually, a slow rebalancing of power between you and the machine you built. Around $300,000 or $400,000, the math starts to change. Now, a 10% year in the market means $30,000 or $40,000 in gains, which is probably more than you can save in a year. You are no longer clearly outrunning the market on contributions alone. They are becoming equals, two engines pulling roughly equal weight. By $500,000 or $600,000, the market is pulling ahead. A decent year gives you more growth than 12 months of disciplined saving. Your contributions are still valuable, but they are no longer the star of the show. And then you hit somewhere in the range of $800,000 to $1 million, and the machine takes over. Part 2. The threshold and why it is not arbitrary. The $1 million figure is not magic. It is not a psychological trophy, though people treat it exactly like one. It is a mechanical threshold, and here is precisely why. The long-run average annual return of a broad stock market index, something like the total U.S. market or the S&P 500, is roughly 7% after inflation. This is the number that every personal finance writer quotes and almost nobody truly internalizes. Not really, not in their bones. 7% of $1 million is $70,000. The median U.S. household income is around $75,000. Sit with that for a moment. At $1 million invested, a typical market year generates something close to what the average American family earns in an entire year of labor. And it does this while you sleep, while you're on vacation, while you are at a dinner party pretending to understand what someone is saying about pickleball. It does not care what you are doing. It does not require your attention or your anxiety or your spreadsheet with the conditional formatting. It simply runs. Before this threshold, you are adding to your portfolio. After this threshold, your portfolio is adding to itself at a rate that begins to dwarf what you can personally add. The median American who maxes out their 401k is putting in around $23,000 per year. At $1 million invested, the expected market contribution to that portfolio in a normal year is roughly $70,000. You are now contributing about 33 cents in personal savings for every dollar the market contributes on your behalf. The ratio has inverted. You are no longer the engine. You are, in a strange and slightly unsettling way, a passenger. Now, some people find this liberating. Others find it genuinely disorienting, because we are trained from birth to believe that effort is rewarded proportionally, that harder work produces better outcomes, that vigilance and optimization and staying informed are virtues with financial payoffs. And suddenly you were confronted with a system that explicitly does not work that way. The market does not care how hard you worked this week. It does not give you extra returns for your discipline. It does not penalize you for watching television. It simply compounds indifferently at whatever rate it compiles over decades. And at $1 million, that indifference starts working in your favor in a way that feels almost unfair. Because in a sense, it is. Part 3. The math nobody shows you in a straight line. Let us actually follow the money, not in theory, in specifics. Suppose you have exactly $1 million invested at age 45. You are still working. You are still saving. You contribute $20,000 a year, which is a reasonable but not extravagant savings rate for someone at this wealth level. The market returns 7% annually after inflation. No drama, no black swans, just the long, boring, historically grounded average. At age 55, you have roughly $2.1 million. Of that $2.1 million, you personally contributed $200,000 over those 10 years. The market added roughly $900,000. You did about 18% of the work, the market did 82%. Now extend it another decade, age 65. Same 7%, same $20,000 annual contribution. You have roughly $4.4 million. You contributed another $200,000 in that second decade. The market added another $2.1 million. At this point, your contributions are almost a rounding error. Not because they are meaningless, they do matter at the margins, but because the compounding engine has grown so large that it is generating annual returns that exceed your annual salary, likely by a significant multiple. You could stop contributing entirely, and the outcome would be surprisingly similar. You could double your contributions, and the outcome would also be surprisingly similar. This is what people mean when they say wealth compounds, but they always say it abstractly, in metaphors about snowballs rolling downhill. The specifics are different. The specifics are this. There is a crossing point somewhere around $1 million where you stop being the primary driver of your own financial outcomes. The market takes that job from you. It does not ask permission. It does not announce itself. You simply gradually notice, if you're paying attention, that the number in your account is moving more than your deposits can explain. And here's the quietly uncomfortable part that most people never fully reckon with. This means that in the later stages of wealth accumulation, your financial outcome depends far less on your decisions and far more on the market's behavior over a particular window of time you have no control over whatsoever. Two people, Both reach $1 million at age 45. Same strategy, same discipline, same everything. One retires into a decade of strong market returns. The other hits a decade of sideways or declining markets. By age 65, they could be $2 or $3 million apart, despite making essentially identical decisions for 20 years. The math rewards you, but it does so on its own schedule, not yours. Part 4. Sequence of returns and the hidden risk. There is a concept in finance called sequence of returns risk. It sounds like something invented to make financial advisors seem necessary, but it is real, and it becomes the dominant risk in your financial life the moment you cross into serious wealth territory. Here is how it works. Average returns are averages. The stock market does not deliver 7% smoothly year after year like a savings account with a good interest rate. Some years it delivers 24%. Some years it delivers negative 18%. Some years it does something completely strange for 17 months and then recovers sharply, and everyone pretends they knew it would. Over long periods, the chaos averages out, but the order in which the good and bad years arrive matters enormously, particularly once you are withdrawing money from the portfolio rather than adding to it. Take two investors. Both average exactly 7% per year over a 20-year retirement. Mathematically identical average returns, but one gets the bad years at the beginning of retirement, the other gets the bad years at the end. Same average, completely different outcomes. The investor who got the bad years first, who retired into a bear market and had to sell assets at depressed prices to cover living expenses, could run out of money entirely. The investor who got the good years first accumulated a cushion large enough to absorb the later bad years without catastrophe. This is not a fringe academic scenario. This is the central mathematical reality of retirement planning. And almost nobody explains it clearly until the window to act on it has mostly closed. Before $1 million, sequence of returns is nearly irrelevant to you. You are accumulating. Bad years just mean you are buying assets at lower prices. Dollar cost averaging works in your favor. A brutal bear market when you are 32 and still contributing aggressively is, counterintuitively, a long-term gift. You are buying cheap. You should be hoping for crashes in your early accumulation years. After $1 million, the calculus starts to shift. After $2 million in retirement with real withdrawal needs, sequence of returns can be decisive. It can be the difference between a comfortable retirement and a genuinely difficult one, regardless of what your average return was on paper. This is why the investor who reaches $1 million cannot simply do what they did to get there. The strategy that built the wealth is not automatically the strategy that protects and grows it responsibly from here. The game has changed. The risks have changed. The failure modes are different. And this is where most people either get it right by instinct or get it very, very wrong by inertia. Part 5. The psychology flip and why it catches people off guard. Here is something researchers who study financial behavior have documented repeatedly and that most financial content carefully avoids saying plainly. The fear of losing money does not scale proportionally with wealth. It scales faster. Someone with $50,000 invested can watch a 20% correction, lose $10,000, and feel genuinely bad about it. They check the account more often, they have an uncomfortable conversation with themselves in the shower, and then they move on, because $10,000, while painful, is not a catastrophe. Life continues. The trajectory is recoverable. Someone with $1 million watches a 20% correction and loses $200,000. $200,000 in months, sometimes in weeks, sometimes in days, even if they understand intellectually that markets recover, even if they have been disciplined, rational investors for 20 years and have seen multiple corrections come and go, even if they know in the cognitive part of their brain that selling now would be the wrong move, the visceral experience of watching $200,000 evaporate is physiologically different from watching $10,000 disappear. Different parts of the brain are active, different hormones are involved. It is not a matter of needing more information or more discipline. It is a matter of the stakes having changed in a way the nervous system has not caught up to. And this is where wealthy investors make decisions that less wealthy investors never have to confront. They panic sell near the bottom, locking in losses they would have recovered from. They move to cash at exactly the wrong moment, missing the violent recoveries that follow sharp declines, recoveries that historically tend to come fast and without warning, rewarding those who stayed and punishing those who fled. They hire advisors to construct elaborate risk mitigation strategies that cost more in fees than the strategies save in volatility. They buy structured products they don't fully understand because someone made a compelling slide deck about downside protection. They let the behavioral problems of success undermine the financial success itself. The cruel irony is this: the investor who was calm and methodical and utterly unemotional on the way up is often completely unprepared for how differently it feels on the way down when there is real money at stake. The psychological tools that worked at $100,000 are not automatically sufficient at $1 million. The numbers are the same math, the feelings are not. And the financial media is making all of this worse, not better. Financial media is structurally built around action. Buy this sector before earnings season, sell that position before the Fed meeting, rotate into this, hedge against that, the smart money is moving here, the dumb money is still sitting there. There is always a new catalyst, a new threat, a new opportunity that requires a response. The content machine demands that you do something, and doing something at this stage of the game is often the single most financially destructive move available to you. The optimal behavior near $1 million and beyond is radical boredom, aggressive inactivity, systematic contributions to a simple, broadly diversified portfolio combined with aggressive and sustained resistance to the urge to optimize, react, and improve. Every serious long-term study of investor outcomes says roughly the same thing with remarkable consistency. The investors who looked at their portfolios least and traded least won the most. One study by Fidelity famously found that the best performing accounts in their system were accounts belonging to investors who had forgotten they had an account or who were dead. The dead investors, it turned out, were beating the active ones. This is not emotionally satisfying information. It runs against every instinct we've been trained to trust. It means that the correct response to a financial system that rewards you for doing nothing is to do nothing, while a very loud and very sophisticated industry devotes enormous resources to convincing you otherwise. That's the environment you're navigating.
Part 6. The thing nobody says about $1 million. Here is the part that feels like it should come with the disclaimer. $1 million invested is extraordinary by historical standards. It puts you in the top 10% of U.S. households by net worth. Globally, you are in an atmospheric category that the vast majority of human beings who have ever lived would not have been able to comprehend. You have, by any reasonable measure, succeeded at a thing most people never come close to. But it does not solve the problem that most people think it will solve. There is a persistent cultural myth handed down through decades of personal finance books and motivational content and retirement plan advertisements that $1 million is the finish line, that once you cross it, you have made it. Financial anxiety dissolves. The future is secured. You exhale for the first time in years. In reality, several things happen, and most of them are not in the brochure. First, you do the actual math. $1 million invested, following the widely cited 4% withdrawal rule, which holds that you can spend 4% of your portfolio annually with a high historical probability of not running out of money over 30 years, generates $40,000 per year. That is below the median U.S. household income. In an expensive city, it covers rent and groceries and not much else. The finish line, it turns out, has moved. It is always slightly ahead of wherever you are. Second, you become acutely aware of how much you have to lose. The early investor with $50,000 has little to lose and everything to gain. The psychological stance is inherently aggressive because aggression is rational. The investor at $1 million has a great deal to lose. And the human brain, hardwired through evolution for loss avoidance, weights potential losses roughly twice as heavily as equivalent gains. This is not a quirk, it is a feature of human cognition called loss aversion, and it does not get better as wealth grows. For most people, it gets worse. The more you have, the more acutely you can imagine losing it.
Third, inflation becomes personal in a way it was not before. When you are building wealth, inflation is a background nuisance, a percentage point that makes the math slightly less favorable. When you have $1 million and are trying to preserve and grow it in real terms for decades, a few years of elevated inflation is not an abstraction. It is a direct, measurable erosion of your future purchasing power. The real return on a 7% nominal return during a 5% inflation environment is 2%. That changes everything. The number in your account looks fine. The thing the number can actually buy is quietly diminishing. And fourth, perhaps most surprisingly for people who reach this level and expected it to feel different, the relationship between money and happiness does not simplify at $1 million. It gets complicated. Research in this area has evolved significantly over the past decade. Early studies suggested that emotional well-being plateaued around $75,000 in annual income. More recent work, including a 2021 study involving hundreds of thousands of participants, found that well-being does continue to improve with income and wealth beyond those earlier thresholds, but that the nature of what you were experiencing shifts. You move from relief to management, from the stress of scarcity to the stress of complexity, from worrying about whether you will have enough to worrying about how to protect what you have, who to trust with it, and whether the decisions you make now will look intelligent or naive in 20 years. These are genuinely better problems. Anyone who tells you otherwise has not been poor. But they are still problems, and they were not in the fantasy. Part 7. The bigger picture, why the system is built this way. Zoom out now, past the individual investor, past the specific numbers. There are approximately 22 million millionaire households in the United States. The number has been growing steadily, accelerated by 2 decades that, despite 2 historic crashes, delivered substantial long-term returns. The mechanisms we have been discussing, the compounding engine, the threshold effect, the way accumulated wealth generates more wealth with decreasing input from human effort, are not secret financial strategies available only to the sophisticated. They are structural features of how the system operates. The reason wealth concentrates is not primarily because wealthy people are smarter, work harder, or make better decisions. Some do, many do not. The reason wealth concentrates is that the mathematics of compounding returns is inherently self-reinforcing once a threshold is crossed. A dollar working inside a large portfolio generates more absolute growth than a dollar working inside a small portfolio, even at identical return rates. Size begets size, not through merit, through arithmetic. Below the threshold, you are fighting friction. Inflation erodes. Costs eat a larger proportional share of a smaller base. Taxes bite harder relative to your margin. Life expenses consume a larger fraction of income, leaving less to invest. The gap between what comes in and what gets saved is often narrow and precarious, maintained by discipline against constant opposing pressure. Small setbacks, a medical bill, a job loss, a car, can erase months of progress. The math does not help you, you are helping the math. Above the threshold, the friction changes character. You are no longer fighting to accumulate. You are managing accumulation that is happening to some degree whether or not you show up. Your primary task is not to achieve something heroic, but to avoid doing something catastrophically stupid. The strategy shifts from offense to defense, from building to preserving, from growth to real growth, meaning growth that outpaces inflation and fees and taxes and the behavioral mistakes waiting for you at every market dislocation. And this means that the financial content, broadly speaking, blurs this distinction almost completely, because complexity sells. Action sells. New strategies and rebalancing frameworks and tactical allocation models and alternative asset classes, these generate content and engagement and advisory fees. Sitting in a simple, low-cost, broadly diversified portfolio and checking it 4 times a year does not generate content. It does not need a podcast. It cannot be turned into a course. The person trying to build wealth needs information and strategy. The person sitting at $1 million or beyond mostly needs to be defended from the information and strategies being aggressively marketed at them. This is one of the more quietly absurd inversions in all of personal finance.
Part 8. The things that actually matter now. This is where a lesser script would give you a numbered list and a call to action. We are not going to do that.
But there are a few mechanical realities worth stating plainly, because they are the levers that actually move outcomes at this level. The 4% rule is a starting point, not a guarantee. It was developed by financial planner William Bengen in 1994, based on historical U.S. market and inflation data, and it has held up remarkably well across most historical scenarios. But it was built on a specific interest rate environment. Many researchers now suggest that 3% to 3.5% is a more defensible number in the current environment, particularly for early retirees facing 35 or 40-year retirements. That gap is not trivial. It is the difference between $40,000 per year and $30,000 per year per $1 million. It is the difference between comfortable and constrained. Asset allocation at this stage matters differently than it did before. The classic advice to shift aggressively toward bonds as you age is intuitive and partially correct. Bonds buffer against short-term volatility, protect you against bad sequence of returns in early retirement, and let you sleep. But they also drag on long-term growth in a way that can genuinely threaten a long retirement. A 55-year-old with $1,500,000 and a likely 35-year financial horizon who holds 50% in bonds may be optimizing for comfort at the cost of real long-term security. The balance is genuinely difficult and genuinely matters. Tax location, meaning which types of assets you hold in which types of accounts, becomes increasingly significant. The difference between holding bonds in a tax-deferred account and equities in a taxable account versus the reverse can compound into hundreds of thousands of dollars in difference over a long horizon. This is unsexy. It requires no market timing or special insight. It is pure optimization of existing rules, and it is one of the few remaining areas where thoughtful action consistently beats inaction. And fees. The silent compounding force working against you. A 1% annual advisory fee on $1 million portfolio is $10,000 per year. Over 20 years, assuming that money would otherwise have remained invested and compounded, the cost of that fee, not just the fee itself, but the growth you lost, can approach or exceed $500,000. Some advisors provide value that exceeds their fees. They exist. But the math on ongoing percentage-based advisory fees is severe, and most people never actually run it. If you have not run it on your specific situation, you should. None of this is exciting. None of it will generate likes. None of it has the narrative satisfaction of a discovery or a contrarian insight that makes you feel like you have finally cracked something. But compounding does not care about excitement. It cares about rate, time, and whether you manage to stay out of its way long enough for it to work. So, here we are, $1 million. A number that functions simultaneously as a cultural milestone, a psychological threshold, and a mechanical inflection point in how wealth actually grows. The moment the machine takes over. The moment your biggest financial risk stops being whether you saved enough and starts being whether you can resist the temptation to do something unnecessary. The investor watching their balance cross $1 million for the first time is experiencing something real, not just satisfaction, something structural and permanent. The relationship between their effort and their outcome has just changed in a way it will not change back. They are now, in a meaningful sense, no longer the main character. And here is what we leave you with. We spend the first several decades of our financial lives trying to matter, trying to earn enough, save enough, contribute enough, decide correctly enough at the right moments. We are the protagonist of our own financial story. Our choices are the plot. Our discipline is the through line. Every optimization we make is an assertion that we can influence the ending. And then, if we do the work, we eventually arrive at a number where the most important thing we can do is accept that we are no longer the protagonist. The market is. Time is. The compounding function is. The protagonist is a mathematical process that was running before we were born and will continue running long after we are gone. And all we can do is attach ourselves to it and try not to fall off. The entire project becomes trusting a process you cannot fully see, cannot fully control, and cannot accelerate through effort or intelligence or superior information. The patience it requires is the patience of accepting that the outcome is really not yours to determine anymore. Some people find that terrifying, the loss of agency, the admission that their role was always more limited than it felt. Some people find it the most peaceful thing that has ever happened to them. The question worth sitting with is not whether you will reach that number. The question is whether when you do, you will have the wisdom to get out of your own way. Most people do not. The ones who do end up fine.